Good morning, everybody, and welcome to the second webinar from the 128 Innovation Capital Group. For those who don't know me, my name is Annette Reynolds. I'm the executive director of the group. And this year we're trying a few different things. I love the idea of having webinars in addition to our in-person meetings and our Piranha Pond pitch parties, because this enables us to sponsor great programs beyond the boundaries of Boston and the Boston area. I am so delighted this morning to have David Sorin of McCarter in English with us. I'm on a regular email list from McCarter in English, and I saw a note, I think it was a blog entry that David had done on the new Securities and Exchange Commission rulings on crowdfunding. And those of us who work in this equity funding space have been waiting for the SEC to get off their duffs and do something about this. It's slowly but surely been happening over the past couple of years. So I picked up my telephone, I called David, I said, David, how would you like to speak to the rest of the world and let us know what's happening? And he was gracious enough to say, of course, not a problem. Good morning, David.
Good morning to you, Annette. Thanks for having me. I'm glad to be here.
Okay, before we get any farther along, some people have asked about ability to stay online. And as you're seeing, David, we're having some delays with your video and your audio being out of sync. This all has to do with internet traffic. We're doing everything over IP, and it's going to happen. But if people just listen, we'll have the slides up shortly, and I'm hoping it won't be too distracting for everybody. Okay,
thanks, Annette. No problem. We all understand the limitations of technology sometimes.
Okay, I'm going to toss this over to you, David. Tell us a little bit about yourself, your practice, and then how you became so interested in this aspect of investing.
Well, good morning again, and thank you so much. As Annette said, my name is Dave Sorin. I am a partner at the law firm of McCarter in English. We are a large law firm with offices from Boston to Northern Virginia, and I chair the firm's practice dealing with venture capital and emerging growth companies. My particular interest in this area began, I have to say, a very long time ago. I was a CPA before I ever went to law school. And during my years in Big 8 public accounting, I developed an interest in entrepreneurial and innovative companies. Later, after going to law school, I started my career at a very large Wall Street law firm, Davis Polk & Wardwell, where I found that my own entrepreneurial instincts drew me not to the very large institutional clients, but rather to the companies that were doing exciting, innovative things in telecommunications, life sciences, back then cable, publishing, etc. And I asked for the assignment of representing the high-tech group of one of our investment banking clients. And so for a long time, my career was really focused on the money side of capital raising involving tech and tech-enabled companies. And then several years later, I was recruited to a very large law firm where I headed the New York and Princeton, New Jersey offices and really built my practice representing not only the money sources, venture capital, private equity, investment banking firms, but to a larger extent, the companies and the innovators themselves. I'm very excited by what it is the innovative leaders do in terms of providing new products, new solutions, new services to the marketplace, and they are the drivers not only of innovation, but of our economy, job creation, wealth creation, et cetera.
David, are you still there?
I am. I had just finished that point. Did you want me to go right into the presentation, Annette?
Be my guest.
All right. Well, thank you.
Your audio is breaking out on us here. David, we can't hear you. David? David, I can't hear you. Can anybody hear David? Type a message in and let me know. Okay. David, we can't hear you. Okay. David, we can't hear you. David, we can't hear you. We can't hear you at all. I have a feeling, folks, it has to do with his computer. Okay, looks like I'm going to have to give him a call. Yeah, we're not hearing your voice.
Yeah, my mic is on, so I'm not sure why you're not hearing me.
Okay, I'm going to ask you. I'm going to ask you to log out or log in. Or actually, folks, can you hear this from my phone? Okay, David, I've got you on my phone. Just talk. Do you want me to put the slides up?
Okay, yeah, that'll be great. Thank you very much. I hope you can hear me now. Terrific, thank you.
Okay, let's try it again. Can I hear you?
All right, well, thanks a lot, folks. I'm sorry about the technical difficulties. Is that the very concept of crowdfunding began because we have a rather restrictive system in place that makes it more difficult for early stage companies and entrepreneurs to raise capital and do so on a cost efficient basis. And it also means that unaccredited investors have been largely precluded from access to some very exciting investment opportunities. So if we can go to the next slide, what we see with Regulation 8 Plus is a long-awaited new rule under the Jobs Act. The Jobs Act, which was actually enacted about 3 years ago, required the SEC to adopt new rules in order to empower concepts like crowdfunding. And the particular rule we're talking about is the one that came out about 3 weeks ago, which updates and expands upon Regulation A. And at its core, the intent is to allow growth companies to raise as much as $50 million from unaccredited investors as well as accredited investors in a transaction that many people refer to as an IPO light. The concept is that investors benefit because they will have access to transactions and opportunities that they didn't have access to historically, and companies in need of capital benefit because they get access to investors that previously were foreclosed from them. We can go to the next slide. Thank you. The notion is really one of democratization. The concept is we want to democratize access to investment opportunities so that individual investors and others will be able to participate in a part of our economy that they've not been able to participate in. On the other side of that equation, the idea is that high-tech startups should enjoy increased access to capital, which, if done right, would not only offer a greater supply of capital, in theory, it'll actually reduce the cost of capital to these very companies, the companies that are the fuel of our economy. And one of the possibilities, and we'll see more about this as we go through, is that entrepreneurs, innovators, and leaders of small companies may be able to forego costly investment banking intermediaries that help them in the sale process, but also which are quite costly. So the hope is that there will be an easier path to capital raising. We have to put all of this into some historical perspective. The Securities Act of 1933 created a highly restricted capital raising system. And we all can understand why. It was a response and a reaction to the stock market crash associated with the Great Depression. And the notion then was to build a system that would be more protective of investors and which would increase confidence in the investing public in our system. The result was that issuers had some limited choices. They could either undertake a costly, lengthy, and burdensome registration process, referred to as an IPO, and then live life as a publicly held company thereafter, or find and rely upon an exemption from that registration requirement. Regulation A was an attempt to allow kind of the equivalent of unregistered public offerings, but they limited the dollar amounts that a company could raise. The limitation was no more than $5 million in any 12-month period for issuers, and for existing holders of company stock that wished to monetize and perhaps diversify their own holdings, the limitation was $1.5 million. If we can go to the next slide. The Regulation A offerings proved to be very rare in recent years. And in fact, most high-tech startups and smaller entrepreneurial companies chose to do their exempt transactions under Regulation D. You've heard rules 504, 505, and 506. But Regulation D has some very serious limitations in its own right, relating to how much capital can be raised, the nature of the offering, and the number of unaccredited investors that may be included in a transaction. So now we can move and look at Regulation A+. The Jobs Act recently amended the Securities Act of 1933 when the SEC was required to update and expand Regulation A. The final Reg A+ rules provide for two tiers of offerings. Tier 1, and frankly the tier that I think is far more important to at least my client base, to entrepreneurial startups in particular, is one that allows issuers to raise up to $20 million in a 12-month period. And Tier 2 allows for a larger raise of up to $50 million. In theory, under Regulation A+, anybody can invest, not just accredited investors. Thank you. Accredited investors have no dollar limits imposed upon them. But under the new Reg A+ requirements, there's still an attempt to protect unaccredited investors, perhaps from their own worst instincts, by limiting the amount that they purchase to a dollar amount that's no greater than the higher of 10% of their net worth or 10% of their net income in a single Tier 2 Regulation A+ offering. Now, one of the benefits is that investors can self-certify as to their income and net worth levels, which frees companies from review and verification procedures to actually do diligence to determine whether or not their investors are accredited or unaccredited. We can go to the next slide. Here's a really important change in the regulations, in that Regulation 8 Plus, in recognition of the way people do business today and in the technology that is available to us, allows general solicitation. Issuers can now discuss and advertise their offerings utilizing social media. Another very positive element of Reg 8 Plus is that the securities that are issued in an 8 Plus offering are deemed to be unrestricted and more readily transferable than securities that are issued under another private offering exemption, Reg D. Now, for those of you who know, in Reg D, issuers are required to limit pre-sales of the securities and actually police them. There's no such requirement in Reg 8 Plus. But in a perceived downside, issuers have to file a disclosure document that includes financial statements, and they must file that with the SEC, and that must be approved by the SEC prior to sale. What the effect is in an attempt to provide information to investors so that they can make an informed decision, companies relying on Regulation 8 Plus have a fairly high burden imposed upon them with respect to this disclosure document. And according to the regs, this document is going to be subject to the same review that we currently see for S1 registration statements in standard initial public offering.
What type of time are we looking at for that kind of review, David?
That's a very good question, Annette. We don't know yet, but if the time is similar to the time in an IPO, we can expect probably about 30 days from initial filing to the receipt of comments. Now, I think, and once we see the financial statement requirements, I think we're going to see less fulsome comments when we look at disclosure documents under Reg 8 Plus, than we see relating to registration statements on Form S1, but only time will tell. And it's a perfect segue here in terms of the financial statement requirements. The smaller Tier 1 offerings only require unaudited, reviewed financial statements. The larger Tier 2 offerings require 2 years of audited financial statements. And certainly, with respect to both of these, but even more so Tier 2 offerings, this adds a layer of cost and complexity to the private offering transaction that may limit the usefulness of Reg 8 Plus, at least with respect to ease of capital raising. But one of the initiatives built into this, into Regulation 8 Plus, is that companies can now allow investors to preview offerings and express levels of interest, something that should be helpful to companies in the capital raising process so that they can preview their transaction before they actually undertake the offering itself. Talk a little bit about the disclosure obligations. In addition to the disclosure document itself, if you analogize to you analogize to an S1 registration statement in an IPO, there's also living life as a public company in the post-transaction environment. Tier 1 issuers, the smaller raises, are free from any ongoing disclosure obligations, such as the 8K, the 10Q, and the 10K filing imposed upon companies that do a public offering. Tier 2 issuers, the larger transaction, have an annual disclosure report filing requirement, and in lieu of 10Qs, a semi-annual report filing requirement, as well as filing current reports. And obviously, you can understand where this comes from. If these shares are going to be unrestricted and freely tradable in a post-transaction environment, the concept is, how do we provide information to the marketplace to allow for a market that can value those securities so that a trading The good news is that the ongoing disclosure obligations end after one full year if the shareholder count is below 300 shareholders.
But you know something, David, I'm looking at this and I'm thinking tier 2 issuers, they can raise up to $50 million, spend $1 million on the reporting and get on with it.
Well, that's a very interesting thought. And, when you look at these tier 1 and tier 2 offerings, to the extent that they are not done with financial intermediaries, we still reduce the overall cost of capital raising for the issuer, because with the ability to use social media, companies can go directly to the prospective purchasers of their securities rather than needing, as we do in an IPO, for example, underwriters, investment bankers who actually market and sell the transaction. The interesting concept in all of this, though, is that the traditional IPO market, which used to be receptive to transactions in the 30, 40 million, $50 million in proceeds range, really are not conducive to companies raising that amount of money because of the cost and the concept of whether or not the transaction makes financial sense for underwriters. So Regulation A+ may actually end up being very helpful in the higher end, the $20 to $50 million range, creating a marketplace for companies for whom the traditional IPO market may not be available.
Mm-hmm.
Another critical element of Reg A+ is state law preemption. Tier 2 offerings, again, the larger ones, do involve a preemption of state law, which allows for the issuing companies to worry only about compliance with the federal law and not worry about a state-by-state review. Tier 1 offerings, however, the smaller ones, and again, in my mind, the transactions where we need the most assistance in creating a more hospitable, more cost-effective environment, there is no state law preemption. Instead, the SEC is relying on the concept, a new system, an untested system of coordinated review between the state securities bureaus and the SEC. This is a complete unknown, and we have no idea how it's going to work at this point. And just like the cost and the time associated with the filing of the disclosure document, there's been concern expressed about the lack of preemption in the smaller transactions and what effect that may have on how widespread Reg A+ actually becomes. One of the good pieces of the legislation is the next bullet point, that the shareholder limits under Section 12G don't apply under certain circumstances here, so we can have a larger number of shareholders without actually becoming an inadvertent public company subject to all of the requirements of a 34 Act registrant. What's our assessment? I've tried this joke several times, so we'll see how it goes over on this crowd. I give Regulation A+ a B-. The SEC has attempted, and I think it's a good attempt, to balance what are often competing and conflicting needs of investors and issuers. Investors need easier, less costly, more efficient access to sources of capital, and investors need access to information that will allow them to make informed investment decisions. So Regulation A+ continues many of the measures that have historically been put in place designed to protect investors from unscrupulous issuers. We've all heard the horror stories of widows and orphans investing in securities in which they have no business investing in. And some might say that the high-risk, high-reward world of tech and tech-enabled startups falls within that definition. Time will tell. Less fulsome regulatory requirements under Reg A should give investors more choices, greater access to investment opportunities, and increase issuers' access to capital. But all of this comes with a very big if, which we'll see on the next slide. We won't see that I apologize. The big if is whether or not issuers will actually adopt Regulation A+ in light of the filing requirements and the absence of state law preemption. And so the jury's out. We have to wait and see what will happen. And I'm obviously happy to take any questions you may have.
Okay, David, can you see the questions on the screen?
Let's see. Let me slide this down.
It says, can a company that is brand new with no financial history raise money this way?
Yes, Harper, that's a very good question. A brand new company with no financial history can raise money this way, much like a company that was in the development stage might have done an IPO. If you have less than the 2 years financial history, you simply provide the financial information from inception until the filing.
I have a question. Let's just say I am in a small company, maybe 20 or 30 people. I have investment through these regulations with 200 people who gave me $1,000, $1 million, whatever dollars. What type of record keeping burden do I have for my stockholders?
You're talking about the company that actually raises the money at this point, or
exactly.
Investing vehicle?
No, the company that raises the money.
Okay, so the company that raises the money is going to have to impose a lot of discipline into their own system. And now, so recall the ongoing requirements. Smaller transactions, there is no ongoing disclosure obligation. Obviously, in the larger deals, we have that annual report, semi-annual report, and the current report requirement. In order to be able to fulfill that requirement, companies are going to have internal systems of control and accounting systems that allow them to report in accordance with generally accepted accounting principles. So that is very important. And one of the things that I think everybody needs to think about, if you do a Regulation A+ offering, even if you do not have ongoing disclosure obligations, either because the transaction was small or because after a year for the larger deals you don't meet the shareholder threshold, we're still going to have to deal with something that is a pragmatic reality, and that is the intent under Regulation A+, is that these shares be freely tradable after they are purchased in the initial issuance. And in order for those shares to be tradable, one would think that the companies who issue them, even if they don't have a legal requirement to do so, may find that their investor group wants them to provide some ongoing disclosure, not only to the shareholders themselves, but to the general market, so that a market can develop for the trading of the securities after the initial Regulation A+ transaction. So I think it is very important to have the a system in place that will allow for appropriate accounting and will allow for at least a reasonable level of disclosure, even when it's not required. And I think that's just a pragmatic result if you do a Regulation A+ offering and have a number of shareholders who are not close to the company, don't have the information as a result of sort of being insiders, and who are going to want the benefit of having an unrestricted security that can be sold in the aftermarket.
Okay, we have a number of other questions here. Marty wants to know, what's the liability to issuers when the actual financials do not meet the reviewed financials?
It is a very good question. And the fact of the matter is the anti-fraud provisions that are applicable in securities offerings generally, not only in public offerings, but in those that involve private offering exemptions. So it's going to be important that actual financials and reviewed financials be the same. And we don't want to be seeing situations where the internal financial statements are somehow different than the financial statements that are produced for disclosure in the aftermarket. And so I do think that it's important to realize that whether it's financial statements or the disclosure generally, the anti-fraud provisions will apply. I see another question from Ben about whether or not startups might be leery of providing financial information to their competition. And Ben, this is a very good question, and it's a question that even companies contemplating an initial public offering have to consider. In any disclosure system, information is provided to the marketplace, whether it's in a registration statement on Form S1 or in a Regulation A+ disclosure document. And you're absolutely right that one must consider the value of the disclosures and raising money using this exemption against the perceived risk of providing information, financial or otherwise. It could be competitive information or strategic information that allows competitors some added knowledge and insight into what your company might be doing. So I don't think Regulation A+ changes the analysis. The analysis is, and I think remains, a cost-benefit analysis dealing with how much information are you prepared to disclose in order to meet your disclosure obligations, weighed against the benefits of raising money in a public offering environment or in a Regulation A+ IPO like.
Okay, what about the role of online portals to vet or review projects?
And I'm really excited about this element of Regulation A+. The fact that issuers are going to be given the opportunity to allow their offerings to be previewed before actually undergoing the fulsome offering, it should allow companies to vet their project, get an indication of interest, and hopefully allow for a much more efficient system of capital raising where, companies don't go through the entire process only to find at the end that there really is not a level of interest that warrants undertaking the transaction in a Regulation A+ format. So I think this is one of the really positive elements of Regulation A+, and I'm anxious to see how it actually works when it's put to the test in an actual environment.
Okay, we have another question here, and this is a question that has been raised over the last couple of years, actually, at some of our meetings. What's the practical effect of doing a Tier 1 offering and then later on looking to raise major, maybe $100 million from venture capital firm? The question has to do with the cap table and the large number of shareholders. Can you speak to that?
Yes, this is a really interesting question. And again, I would say that this problem exists in the current environment, in the situations where you see companies having undertaken a rather large sort of angel or friends and family offering prior to doing a venture capital deal. There are some who believe, and I've certainly seen it in practice, that having a significant number of individual or angel or friends and family investors may be incompatible with having venture capital investors because often they have competing interests and time horizons. So I think that issue exists, again, with or without Regulation A+. I do believe that one of the benefits of Regulation A+ that mitigates the issues that might arise from this question relate to a reality that we're seeing in the marketplace, which is that companies are less capital intensive than they were before. Companies can get to commercialization, do their development, get to commercialization, hopefully start producing revenue, producing positive cash flow, and hopefully profit with far less capital than ever before. And it's one of the reasons why a Regulation A plus offering may be very helpful. I think it would be the very unusual circumstance where a company would do a Regulation A plus offering and raise $5, $10, $15 million to try to raise $100 million from the venture capital community later. I think that if a company successfully does a Regulation A plus offering, raising that kind of money, they will either do additional Reg A plus offerings going forward, or perhaps mature to the point of being a viable IPO candidate, or frankly, the most likely scenario of all, which is that their monetization or exit event is a sell-side transaction.
Okay, thank you for that. Now, are there limitations to international uses of funds raised?
The international uses of funds, I'm going to have to get back to you on that question. I have not studied that issue. I don't believe that there's a limitation, for example, where you raise X dollars and you can't market or develop or internationalize using proceeds from the transaction. But I'm going to have to take another look at that and get back to you.
Okay, I have a pragmatic question. Let's say that I want to take advantage of this new system. How do I go about doing it? Must I go to an online portal? Can I just advertise on Facebook? How do I do this?
There is not a requirement that you use any particular portal. There's not a requirement that you actually utilize social media. These are tools that are available to issuers, but they're not a required element of the transaction. I think it behooves a Regulation A plus issuer to utilize and benefit from the ability to use social media, to use online portals, because it will allow them to more efficiently reach their target market. So I think it's a very positive element of Regulation A plus, but not a required one.
So I can just go put an ad in the local newspaper and collect checks and keep track of it?
Well, as long as you do your disclosure document as well, file that, because you cannot collect checks until your disclosure document has passed muster with the SEC and gone through that review process. So we can use the portals, we can use advertising, we can have previews of the transaction, but we cannot actually issue and sell securities without having successfully gone through that registration process.
Okay, another question. Is the issuer legally exempt from Sarbanes-Oxley?
That's a very good question, and I don't know the answer to that. I'm going to have to look into it. I don't believe the answer is yes, but I am going to have to look at that for you.
Okay, if you're raising your first seed round and have a big consumer user base plus personal network of qualified investors, how would you go about raising $300,000?
Your question is spot on insofar as it relates to Regulation A+. When we look at A+, we're looking at transactions not in the several $100,000 range. These are for companies that want to raise multiples of millions. Doesn't have to be $20 or $50 million, but certainly I believe that Regulation A+ will be used in those transactions that far exceed smaller deals raising $300,000, $400,000, $500,000. Those transactions will not support the added costs associated with doing an A+ transaction, and therefore I would say that if you're looking at a $300K deal, you want to look at other sources like convertible note financing, friends and family, safe, simple agreement for future equity transactions, and not Regulation A+. Okay.
And Jeff wants to know, is there a step-by-step process or a checklist? Do we have a guidebook?
There is no guidebook produced by the SEC. The guidebooks, frankly, are being produced as they usually are by the service providers, the accounting firms and the law firms that assist issuers in their offering process. So we have created a process that we will be utilizing as we work with our clients doing Regulation A+ transactions, and that includes the adoption of checklists, agenda, etc., much like we've used historically in the IPO process, although it'll clearly be an abbreviated process when compared to a registration statement on Form S1.
So effectively, the best step, if somebody is looking to do this, is to speak to somebody like you or their attorney who works with early stage companies, and to define a path with them.
So I think that's absolutely right. You want to make sure that you have an accounting firm and a law firm advising you so that you can ensure that as you seek to raise funds, utilizing the new regulations, that you are abiding by those regulations and doing this in a way that will be as cost efficient as possible for the issuing company. And time will tell if Regulation A+ achieves what we had hoped it would achieve. And unfortunately, I think the jury is out on that. I think there's some very positive elements of Regulation A+, but I also believe that there's some serious impediments to its widespread adoption, and it's critical that issuers make sure that they are speaking with their law firm, their accounting firm, people who are experts in doing capital raising transactions, and there are a lot of very good lawyers and a lot of very good accountants out there who will be focusing on helping their clients raise money utilizing Regulation A+, just as we have in IPOs or in other exempt transactions.
I've got another question here. Can you discuss state review? Does it tend to be more onerous than the SEC review?
Mark, that's a very good question. As we see, there will be state law preemption in the larger transactions. As for the smaller transactions, the hope that the SEC has is that it will develop into a system where states begin to rely on the SEC review process, and under this system of coordinated review that is intended to be developed, that we won't have a situation where issuers in the smaller offerings actually have to make sure that they are complying with the state-by-state regulations. Normally, in a Reg D offering, for example, or in another private offering exemption, we know exactly what states' offers are being made in, and of course what state sales are being made in. But in a Reg A+ offering, if social media is utilized, we would have to be looking at 50-state review. So I do have a concern about the lack of state law preemption for the smaller offerings, and I am anxiously awaiting what actually happens with the development of this coordinated review that the SEC refers to in the regulations.
The next few questions have to do with how much you think this is going to cost in legal and accounting fees to raise this money. Any idea?
That's a really good question. We all can look at the costs of an IPO, which have ballooned tremendously. The average IPO, between legal, accounting, and other costs, those transaction costs rapidly grown to $1 million or more. I don't foresee costs anywhere near that in a Regulation A+ offering. There will be an unaudited review requirement for the smaller offerings, so there will be accounting costs incurred, but those costs would be far less than the costs associated with an IPO. Obviously, far more than the costs associated with doing a private offering today if you don't have an offering memorandum and if you don't include financial statements in your disclosure documents. For the larger deals, there is a requirement of 2 years audited financials. I still believe the cost will be far less than those associated with an IPO, to the extent that the companies utilizing A+, obviously have far fewer transactions to report, a far simpler accounting system, and that same analysis would apply to legal costs. We have companies that have far less history, far fewer contracts, far fewer disclosable items, but there will still be some reasonably substantial costs in preparing the offering circular. But I would analogize that more to a private offering memorandum than I would to a registration statement on Form S-1. And to the extent that this is done without financial intermediaries, we don't have multiple parties involved in the drafting process, which would simplify that process and reduce the cost.
Okay, and Rick's wanting you to be more specific. He may want to write you a check.
The rough estimate, I see Rick, asking questions, 10K, 50K. I think it'll be far more than 10K. And with respect to where it ends up in 50K to 150K range will depend largely on the accounting and law firms that are utilized, what their billing rates are like, whether they are truly experts in transactions of this nature. I believe the costs will be lower when you utilize service providers who actually do this all the time and aren't dabbling in transactions of this nature. But even then, there's a very large range in terms of billable rates and what the transaction expenses are going to be. If I'm looking at a $10 million raise, I think that it would not be unreasonable to be thinking about total transaction costs somewhere around $250,000, which is still a very small percentage of proceeds.
Okay. Eric wants to know, can you provide a real-world example of frequency and extent of operating and financial disclosures? This is not defined in the regulation as far as I can see, but what do you think would be realistic?
You're right, Annette, and Eric, it's a great question. There is no obligation to provide these kinds of ongoing reports or financial disclosures. So companies could adopt the policy that they don't report. And while I think that would be legally sound analysis, pragmatically, I don't think it's a good idea. And certainly that will depend upon the number of investors in that transaction. But I do think that it's a matter of good practice to make sure that investors are, given at least regular information. Many of my privately held companies, for example, do provide either a quarterly or semi-annual update to all of their shareholders. That might be something that a Regulation A+ offeror who's done a Tier 1 transaction might choose to do, and certainly more frequent reporting if appropriate for very material events or transactions. But it's important to note that if disclosure is provided, you have to make sure that you comply with disclosure requirements, and you can't cherry pick, and you can't provide disclosure to some of your investors and not all. So I think it's going to be a matter of developing best practices internally, and I do think those practices will include timely, ongoing disclosures, certainly not to the level of 10Qs and 8Ks and 10Ks, but something that keeps the investor group informed. And I think it's important if there's going to be the ability for those shares to be traded in the aftermarket. we know that Regulation 8 Plus is providing that these shares are unrestricted. But you can imagine that a subsequent purchaser is going to want to have information when making his or her or his investment decision. And I think it'll behoove the Regulation 8 Plus issuer to make sure that they're participating in that process.
I would not be surprised if there were an amendment to the regulation to require some kind of reporting. As an investor, I would want at least annual or semi-annual financials myself.
I agree. And, there's a question that was just raised on these smaller deals. Does the lack of ongoing reporting concern us when it comes to post-issue selling, especially by insiders?
Absolutely.
And Mark, that's a great question, and it dovetails precisely into what we were just talking about. I think that the lack of ongoing reporting does not mean that the smaller issuers should not report. And as we were talking about, I think that smaller issuer should, in fact, develop some kind of ongoing, consistent reporting mechanism for precisely the reason you're addressing.
Now, we're getting close to our 9 o'clock finish time, but I have one question for you, David, or asking your opinion on this. When the Jobs Act was first mentioned and passed, I heard a lot of people saying this is going to ruin the angel investment market, others saying it's going to be the best thing that's going to happen. What do you think I've heard all sides of it. Looking into your crystal ball, what do you see happening, particularly to the angel investment market, as this law becomes more active and people start investing this way?
These are really good questions. And as with most things, I think the truth and the reality will lie somewhere in between. I do not believe that this destroys the angel market. I believe, if anything, we're going to see the creation of a more efficient marketplace. Regulation 8+ and crowdfunding generally are no different than what we see in numerous other markets where using technology creates a far more efficient marketplace, a larger marketplace. So from that perspective, I think it's very positive. The other side of this, however, is that what people might have believed, expected, or hoped crowdfunding would be, the regulations put in place to date certainly don't support as widespread a crowdfunding mechanism as might have been hoped for by some. There are still some rather restrictive regulations in place, as we saw here under Regulation 8+. I don't believe that 8+ will be widely adopted for smaller transactions, which relates right back to one of the questions we received earlier. I think the cost infrastructure and the regulatory environment associated with 8+ mean that it is more likely to be utilized in sort of larger transactions. I'm thinking $5 to $10 million and up. The marketplace that might have historically been the realm of larger venture capital funds and public markets, when the public markets were still receptive to what we would call smaller IPOs, the $20, $30, $40, $50 million range. It's very difficult to do an IPO with that level of proceeds today. It's not cost effective, and it's not financially rewarding enough for the underwriters. And so I think that Regulation 8+ may fill a void for those kinds of companies, the ones that can and should be raising some significant dollars, but less than dollars that would be raised in an IPO environment and for companies that are not yet IPO viable. But with respect to the transactions in that sub $5 million space, that so many of the early stage transactions are sub $3 million. Well, Regulation A Plus is not going to respond to that, and the other crowdfunding rules in place to date don't respond to that. So very early stage transactions still require, I think, some real assistance from the regulators to make for a more cost-effective and efficient marketplace.
Okay, this has been a very, very informative session, David. I cannot thank you enough. We do have one question. It sounds like Reg A Plus disenfranchises investment bankers. Do you want to comment on that?
Yeah, no, Reed, this is a really good question. There obviously is a critical role for investment bankers in the capital raising environment. They are essential both to issuing securities and to what happens in the aftermarket. So investment banks and investment bankers aren't going anywhere. I do believe, however, that in smaller transactions, the ability to use social media, the ability to actually do deals in that sub $50 million range will reduce the reliance on investment bankers to actually help sell securities in the smaller transactions where, frankly, these transactions are not economically viable for many underwriters, and the ability on the part of issuers to reach investors directly may in fact reduce the role of intermediaries. And this is very similar to what we see happening in lots of marketplaces for other products, goods, and services, not just securities. So while I don't think it's disenfranchisement per se, I think that certainly in larger deals, investment bankers are absolutely critical. In Regulation A Plus transactions, some clearly will still require the benefits and the services of an investment banking intermediary, while others will not and will allow issuing companies to go to prospective investors on a more direct basis. But time will tell. This, I think, is maybe one of the most interesting and perhaps unintended outcomes associated with Regulation A+.
Okay, we have effectively run out of time. David, thank you so very much. Folks, if you have any other questions, we didn't quite get to all of them, send them to me or send them to David directly. His email is up on the screen. As you all know, pick up the phone, call me, send me an email, and we'll make the connection. Thank you all so very much for coming. David, if you could stay on the line with me, I'm going to end the presentation, and we can just discuss a few things, how to keep you involved here. Thank you.
Thank you all